All right, folks, let's dive right into it. What is a mortgage, you ask? Think of a mortgage as a giant loan specifically designed for buying property. It's like borrowing a big chunk of money from a bank or a lender and promising to pay it back over a long period, usually 15 to 30 years. Now, here's the kicker. The property you're buying acts as collateral. That means if you can't keep up with the payments, the bank can take back the property. Sounds serious, right? But wait, there's more. Mortgages typically come with two main components, the principal and the interest. The principal is the amount you're borrowing, while the interest is what you pay the lender for borrowing that money. Simple enough? Okay, let's break it down further. There are different types of mortgages, but the most common are fixed rate and adjustable rate mortgages. With a fixed rate mortgage, your interest rate stays the same for the entire loan term, predictable and steady. Meanwhile, an adjustable rate mortgage, or ARM, starts with a lower interest rate that can change over time, usually after an initial fixed period. Now, before you jump into grabbing a mortgage, you'll need to qualify for one. Lenders look at your credit score, income, and employment history to determine if you're a good candidate. The better your financial health, the better your mortgage terms can be. In conclusion, a mortgage is a powerful tool that can help you own property, but it's crucial to understand the ins and outs before diving in. Remember, it's a long-term commitment. Thanks for tuning in. If you found this helpful, hit that like button and subscribe for more financial tips. See you next time.